Are you still drip feeding money into the markets? We're hearing a lot of you say that you're holding off on investing until the second market crash arrives. But what if it doesn't?
The idea that there will be a second market crash is predicated on current market prices, which are as high as they were before the coronavirus was known about, which surely can't be right, can it? But the more we think about it, the more these high market prices make sense.
If government meddling in the money markets has had the effect of setting a new higher floor to where stock prices can reasonably fall to, maybe this has offset the effect of lockdown on stock prices, leaving prices around where they were at the start of 2020.
Magic money printing means that cash is no longer king, stocks are. Let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Cash in the asset mix. What's really interesting is if you think about cash as just another asset class that you can trade for other assets, the same is true of stocks. You could trade stocks for cash, or stocks for gold, or gold for property, and so on.
If we think of cash as part of an asset mix, we can start to think of movements in price as like an exchange rate between different asset types. When people say that the stock market is up, they mean it's up relative to cash. But the stock market is not overpriced relative to gold, and it's not overpriced relative to bonds. So does it help to think about cash as having gone down in value relative to stocks?
Yes, because we know that since the pandemic started, governments and central banks have been flooding the economy with magic money. They call it quantitative easing, but that's just a fancy way of saying printing a load more dosh and claiming that it has value, just because.
Cash debasing. It used to be that a banknote was linked to a physical asset in a vault, usually gold. Pull out a fiver and you'll see the words, "I promise to pay the bearer on demand the sum of £5. This phrase is a promise to pay the bearer the equivalent amount of currency in gold or silver, and comes from the days before quantitative easing, when money's value was based on something more than hope. We doubt though that the Bank of England would actually shave you off 1/10 of a gram of gold from a bullion bar if you did show up there with a £5 note.
QE is actually done digitally, so it's even easier to fiddle with. Just whack a couple of zeros on the end of a bank balance and poof, the country has liquidity. So we know that cash must be being debased in value. There's now a lot more of it, and we know that when the supply of something goes up, its value goes down relative to other assets like stocks, property and gold.
Comparing cash in circulation to the stock market. If we start our comparison period a couple of years before the last recession to factor that in and not skew our results, since 2006 the cash in circulation in the US has gone up around 2.5 times. We picked the US because the dollar is the currency of the world and America is the world's main economy. All other things being equal, we might therefore assume that the other asset classes had increased in value relative to cash by at least 2.5 times.
If we look at the S&P 500 index, a stock market index famous for its incredible growth and America's top index, it has also gone up by around 2.5 times over the same period. Since stocks have been actively making profits since then, you might argue that stocks are still undervalued relative to cash.
Gold price versus stock price. This argument is even stronger when we compare stocks to gold. Gold is up nearly 3 times in price relative to cash since 2006, while we know that over the same period stocks were up around 2.5 times relative to cash. In one way, we trust gold more than cash as a store of value because there is a fixed amount of gold in the world, while they could keep printing cash forever if they wanted to.
This comparison implies that stocks might yet have some headroom to grow until it catches up with gold. If it were possible to buy stocks with gold directly, and gold was just seen as another currency without a moving value, like people think of cash today, then you might conclude that stock prices had in fact fallen.
In this alternative view of the universe where we buy and sell things using gold, the easily manipulated magic money that we call cash could be said to have fallen in value too relative to our gold coins. We only consider stock prices to be high relative to cash, but they're not high relative to real money, gold. We need to consider all asset types in relation to one another, not just how expensive they are when compared to cash.
The 2009 crash. Wasn't there a far bigger stock market crash in 2009 than what we've seen so far in 2020? Doesn't this mean that the stock market has a lot further to fall? It's true that in 2009, investors withdrew their money in huge droves from the stock market, resulting in a crash.
But investors had to decide whether to keep that money where it was or else go somewhere else with a better perceived balance of risk to reward. And investors had different alternative options available to them back in 2009 to what they have today. Back then, cash was still worth something. Interest rates were over 5% in the UK and the US, and QE wasn't commonplace yet, so the money supply was more predictable. This meant that cash was an attractive and plausible alternative place to store your wealth.
This is no longer the case. Historically, the 5 great asset classes are stocks, gold and other commodities, property, bonds, and cash. Cash is now off limits to all but the financially illiterate, so it makes sense intuitively that wealth would disperse somewhere else between the remaining asset classes. Yes, even during a pandemic.
Back to the future. What we've seen in 2020 is, after an initial crash, is that investors are continuing to choose to store their wealth in stocks, bonds, gold and property.
Some companies are affected by social distancing, but the stock market is diverse and many companies carry on as before. Stock markets have returned to roughly where they were before the crisis.
But companies that make it through this period will be, in a lot of ways, be in a better position than they were before in terms of future outlook. Interest rates are now almost guaranteed to remain low long term, as a result of the massive debt racked up by almost all world governments.
No one can afford for rates to go up after all this spending, so they won't. No longer will votes by central banks be split on whether or not to raise rates. Future votes will result in a clear no way. If you have a well-diversified global stocks portfolio or invest predominantly in global ETFs, then you will be able to absorb the hit when some companies struggle, as many other companies will adapt and thrive as good companies always do.
And as for gold, gold has no correlation with social distancing measures. It's a place where investors can go safely when cash fails them. And if stocks pin closer to gold price movements than they do to cash, maybe that's an indicator that this is not a bubble about to pop.
Wishful thinking? A lot of you will say that this is wishful thinking on our part, but it's really not. We'd love a crash. We each have a war chest of cash ready to drop into the markets on the off chance that there is a second crash, but we're still drip feeding cash into stocks on a regular basis, even while prices continue to rise.
What if the market doesn't fall again and you were waiting all that time for a crash and missing out on all that steady growth?
Where to store your wealth? The off-the-scale levels of debasing done by governments and central banks during the COVID era have confirmed that cash is a worthless place to store wealth, with both a falling value and a non-existent interest return.
It makes sense for other asset classes to have risen in value relative to cash, and we've argued that it could be seen not to have risen at all, and that cash's value has fallen away from them, which makes a regular drip-feeding stock market investment strategy worthwhile.
Question of the day: do you think this second crash is on its way, or have people been ignoring the fact that cash is now worthless? Let us know in the comments below.
Thanks for watching. On this channel we're talking about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.